Hello and welcome everybody, and thank you for joining us at our Intelligent Investor series. Today, we will be talking about what it takes to build a real estate empire with insights from our founder himself, who's done it all before. Hi, Tim.
Morning, all.
Joining him will be Ian Pryor of Expat Advisory Group based in Singapore. With more than 10 years of global investment experience, he will not only be able to give his insights on property investing, but also on other asset classes. Hi, Ian. Thanks for joining us.
Hey, hello.
All right. Over to you, Tim.
Okay, well, good morning, everybody from the UK. I guess you're joining from all over the world, predominantly in Asia and the Middle East. I was just trying to figure out now how long ago it is since A, I began IP Global, and B, bought my first property. Well, I actually bought my first property in October of 1993. So that kind of shows my age a little bit. And through the process of buying that first property, and it was a pure investment property, and all the properties I bought since, and then in creating IP Global 16 years ago, I've seen a lot of changes in the global property market and learned a heck of a lot during that period. And hopefully, condensed into less than an hour this morning, we can discuss much of what I've learned over the years. Mostly good, but also some bad and some challenges. We can kind of talk about that and take your questions. A couple of just quick points about IP Global, which I founded I incorporated in September of 2005. So yeah, over 16 years ago. In that time, we've transacted approaching 6,000 properties in 18 countries, and with over $3 billion of our clients' money and a lot of our own money as well. Next slide, please. Oh, sorry, sorry. Maybe you should be doing that. So yeah, that's a little small piece in our track record, and perhaps as we go through the questions today in the various sections, we can talk about what we've learned from all of those markets. Thanks, Nicola.
All right. So just to recap, what we have on the agenda today is the investment asset comparisons, which Ian will lead the way on. And then we'll talk a bit more about how property creates wealth, with how Tim has managed to do it for himself, as well as how to find your investor profile and what really is important to ask yourself. And then also, of course, the important research to do to make intelligent decisions. And also some cautionary advice on currencies, inflated yields, and local affordabilities that have helped both of our hosts make smarter investment choices. All right, so let's start with Ian. Ian, would you mind taking us through some of the investment asset comparisons and what you've learned?
Yeah, sure. Thank you, Nicola. I guess these are the 5 key sort of asset classes, if you like. There are obviously lots of different sub investments one can make, but as a summary, I guess you're looking at stocks, which are typically used for growth and are trying to achieve high returns. And then on the other end of the scale, you have cash, which is obviously needed for day-to-day spending, liquidity, rainy day reserve money, and also just to defend people's investment portfolios. Then I guess the middle 3, these are sort of the diversifiers. Bonds again are quite sort of defensive, but also people use them for income, to receive a regular income stream with some certainty. I guess real estate is the crossover between, I guess, all of these. A real asset, something where you can get a yield and some income, something you can keep up with inflation, and something you can also use for growth. The other one, of course, is gold. Gold, I guess, is the ultimate in terms of diversification. It's another real asset. I guess the key difference between that and real estate will be that it doesn't yield anything. Real estate, you can rent out and receive an income. Gold doesn't actually give you any sort of income, but again is seen as a diversifier. So I guess these are sort of the 5 key asset classes, if you like, which you may or may not own, one or all of them, perhaps. And typically, as an asset manager and a financial advisor, we look at all of these and try to find, the best combination for the individual, but also the best combination for the point in time we are in any economic cycle, any opportunities, and of course, any risks. So I'm just curious, I know very little about real estate. Tim obviously is the expert. Tim, I'm just wondering, what made you choose, real estate as your key asset class, and maybe share some of your experiences in that area?
Yeah, I think my original decision was really simple. I was a young guy and I didn't have much money, and I saw the opportunity for really material growth in my asset and my small asset base at the time, because I could leverage. So back then, I mean, it's very interesting really when I think about my journey with real estate, which kind of began very much more as a yield play. In the middle, it was much more of a capital appreciation play, and perhaps now, as I'm getting a bit older, yields come back into focus. But when I started, my first property was a student purchase in the UK. The yield was strong. The asset value was cheap. I mean, we were talking about the property value in the 50, 60,000s then. I could take a 70, 80% mortgage and need minimal capital down, and the rents were high. So my first inclination was, where else as a young guy with a few £1,000s could I make an investment where at that time I was making a clear carry on my mortgage every month. I was making an income of, at the time, over £500 on top of my mortgage every month, that I could then use that money to then put down as equity to buy another one, and almost not really care about the capital appreciation, because it was so profitable as an income play that there was nothing to compare with it. Now, times have moved on, obviously, and as times have moved on, property prices have escalated massively in the last, well, since I did that, which was nearly about 25, 27, 28 years ago. So it's much more difficult to buy property at those values now, and yields have come off. But what has got better in that period is interest rates have come down a lot. So you still can find those investment opportunities. Perhaps they're not as easy to find as that. So that was my first kind of taste of real estate. And what kind of then, Ian, got me to continue, even though the yields came off a bit, was that I saw, when the yield wasn't always there was always capital appreciation in the background. So it enabled me to refinance, and we'll get onto this later, but it enabled me to refinance properties as the values went up, take that money out, and then use that as equity to build up my portfolio. So at some point or another in the last 25, 27 years, I've either always been making money on my yield or always making money on my capital appreciation, and sometimes both at the same time. But it was really, I kind of fell into it really because at the time it was the most obvious and the only thing I could do with a relatively small deposit. I think that's a cue for me to talk about something else, is it, Nicola? Apologies.
Thank you so much, Tim. So what is it that you look for, and what are the things that really make for a good investment case with property?
Yeah, well, I think, again, when I started, like most people, I bought my first property in the place where I lived. I could see it. I knew it was there. I knew it existed. I knew what the rents would be. I even knew who the tenants were because I interviewed them before I gave them a room. The world has changed for me since then. And many of my properties and those of our investors in IP Global are in countries they don't live in, or in cities that they don't live in, and they never meet their tenants. So if you're that distant from your investment, how do you get your hands around it and feel that you're making a good decision? And some of the things I would say we always should be looking for are, the reason that one of the drivers to set up IP Global was really, what are the great cities of the world? Where are the populations growing? Where is there an undersupply of real estate that will ultimately mean you will always get your flat rented out or your house rented out, that the asset value should, over the medium to long term, always appreciate because of a supply and demand imbalance. And those are the things I look for: the growing cities, the growing populations. Most big cities, the populations are growing, infrastructure is getting better, but they're not building enough properties quickly enough. And that definitely is the case in the UK and many other cities around the world, where we do a lot of investing in Germany, we invest in Portugal, exactly the same. There's a flight to those cities where the jobs are, where the intelligence is, where the universities are, but there's not enough real estate. So I still look at those dynamics whenever I'm looking at investing in a property market, whether it's Sheffield, Birmingham, London, Lisbon, Berlin, Leipzig. It's the same underlying economic factors.
Thank you, Tim. And then just a couple more benefits that you find, particularly to real estate investing.
Sure, I'm cautious not to pinch some of the things we'll probably talk about later, but gearing is, and we'll talk a bit more about mortgages later, but gearing is a huge advantage. Having that ability to always gain on the whole asset value without having to put all of the money in at that time, to buy a $300,000 investment, but only to perhaps invest $70,000 or $80,000 in that investment, but knowing that it can go up proportionately to the fact that it's a $300,000 investment is massive. But I think for me, things like the security of the asset, if you know what you're buying, there's a demand for it through thick and thin. We have probably the longest and most sustainable run of low interest rates behind us and in front of us, even though we will see some inflation doubtless in the coming years. To know that you're able to own that asset at relatively low cost, to know that if you buy in the right place, you'll always have a yield on that asset. I just find it very difficult to ever get excited about anything anywhere near as much as I can real estate. And even now, as a 51-year-old, I don't think I'm any less excited about real estate than I was at 21, 22.
Thank you very much. And Ian, do you have any advice on the return on investment of the other asset classes as well that you could share?
Yeah, sure. So I think this slide shows, I guess, the three key core asset classes. We mentioned two others before, but cash, like I said, is your utility, it's your spending, and shouldn't really be used too much for savings in the long term. And the other one's gold, which, as I said, is more of an insurance policy, if you like, disaster management, and something like a safe haven, real asset to hold. Things go really wrong. So these are very much the three key asset classes. And I think what Tim mentioned just now, what stands out with real estate is it can really tick pretty much every box in the investment universe, because you have that ownership, you have as much or as little control in the property that you want, but you're getting the income. You've got a good chance of keeping up with inflation. You're getting growth, and I think one of the most important areas when we look at return on investment, and as Tim mentioned, he'll go into that more later on as well, but it's the ability to leverage, it's the ability to naturally invest a small amount relative to the total value of the asset, but actually reap the returns on the whole thing. And that's really fantastic. And you can do that with stocks. There's lots of fancy different sort of financial instruments that you can use, things like futures, etc. But that really has a next level, I guess, of research, knowledge that you need in order to do that. And that sort of leverage is natural. It's natural when you invest in property because of the mortgage factor. So I think now you can see on this slide the benefits of a mortgage. And I guess, Tim, are you going to run us through this?
Yeah, I guess so. Yeah. So as I was alluding to before, this is assuming that the property value is 100,000. We wish, right? But you can see that with a down payment of 10% of property value and a mortgage at 20-year 6% interest rate, and obviously assuming various costs, you can see the total return after you selling it for 238,000 after 20 years is so much more significant than you would ever get in any other form of investment. Now, people sitting there who are active investors in stocks and leveraged stocks might argue, well, you can do exactly the same in stocks, and you can, but it's very, very risky, and it's very rare in retail investment environments outside of places like Hong Kong. But in Hong Kong and some markets, not just sophisticated investors, but regular investors may decide to leverage up on a stock portfolio. But the stock market can move much more rapidly than the real estate market, and you might get called on a margin, meaning that you're suddenly underwater on your investment and you need to make up the difference. Now, that's incredibly unlikely and rare in real estate, where the real estate value might go down by 2 or 3 or 5% in a year, or up by the same. The bank is unlikely to ever, well, the bank will never call you in on needing to put more money in unless you're in a negative equity situation. And for those of you who don't know what that means that you owe the bank more than the property value. But that really only happens in the event of property crashes, and we haven't seen that. We haven't seen that at all in any of the markets that we're currently working in the last 20 years. So if you hold a meaningful deposit against your property, which is anything from 20, 30, 40%, then it's exceptionally unlikely that you're ever going to be put in that level of risk. But at the same time, if you put a 30% deposit down on your property and the property value goes up by 30%, in very simple terms, you've doubled your money, rather than just made 30%. So I know there are other costs to take into account, and we always cover those in our cash flows, but that is the benefit of a mortgage. And we would always recommend our investors, where they can, to take a mortgage. And we'll talk about currencies and mortgages later, but that in the essence is the biggest benefit of buying a property, but above everything else.
Thanks, Tim.
Sorry.
And could you also give us a couple of some of your advice on the benefit of refinancing as well? I know some of our viewers have questions about that.
Yeah, I'm a big advocate of that. And again, let's not beat around the bush. It's not always as simple as you'd like it to be. And God, you know, the amount of time I spend refinancing some of my properties, and my good man Steve Rose, who works for me and does a lot of the work for me, it's not always as simple as you'd like it to be. And I definitely recommend the use of a decent broker to help you. But you know, you might have bought a property 5 years ago, 10 years ago for $200,000, and it may well be worth $300,000 now. And if you're lucky enough to be in that situation, and you have a $160,000 mortgage, you have the opportunity to take maybe another 50, 60,000 out, use that deposit, use that as a deposit on a second purchase, which is very common in the real estate world. It also, remortgaging also may give you an opportunity to get a better rate. Banks can be very naughty at leaving you with them and forgetting to tell you, or telling you in small print that you're now your rate has finished and that you're now on the existing mortgage holder rate, which is not anywhere near as attractive as the original rate that you were paying. So be very careful with that, and make sure you have a look, because it could be that you're paying more on your interest rates than if you were to go to a bank, another bank, or even the same bank, and say, hold on a minute, you know, I'd like to fix my rate for 3 years, or I'd like to fix it for 5 years, or I'd like a discounted variable rate. So it's always worth looking around. And look, it's definitely easier for some people than others. We have challenges with some of our investors who live in far-flung places, particularly Africa. It can be sometimes challenging, but there are always mortgages out there, and the more equity you've got, the easier it is to get a decent loan. And obviously, if you own property in solid markets like the UK and Australia, the US, Germany, Portugal, those sort of markets, generally they should always be mortgageable. So I'd always keep your eyes out for a refinance. You know, you're going to need to be prepared to spend some money on a lawyer when you do that, and it might take 8 weeks rather than 2 weeks. So don't believe anyone that says it'll happen in 5 minutes. But yeah, definitely worth thinking about.
Fantastic, thanks. All right, Ian, would you be able to discuss the importance of being a cautious or aggressive investor and finding your investor profile?
Yeah, absolutely. I think if you just use, you know, the topic Tim just talked through with mortgages, that's actually a great example of one of the aspects that you really need to consider. Of course, someone that's very, very cautious may want to use cash, may want to even buy the property in full. I know plenty of people actually that have done that and have done so recently even. Of course, a slightly more aggressive approach would be to mortgage it. And, you know, as Tim mentioned, you could even mortgage it and then subsequently refinance it in the future. You could take equity out, you could buy a second property, buy a third, buy a fourth, and so on. This is actually what I did. I'm an IP global investor myself, and I bought my first property 5 or 6 years ago. It's a long story, which I won't go into today. I actually ended up buying it in cash. All it was really was the Brexit referendum, and I saw quite an opportunity in the cheap pound. I live in Singapore, so I had Singapore dollars. But yeah, I subsequently financed that and got a mortgage, and recently just bought my second property with them. So, you know, this sort of technique is very good at accumulating assets and building a property portfolio. But you do need to look at your risk profile. And the story that I just told then, the risk profile is very important, because leverage, of course, you know, can work two ways. There's the peace of mind, I guess, of owning the total asset. There's not only peace of mind, it also means that 100% of the rental income is yours. So you need to take all these different things into consideration when you're buying a property. I guess the second side of it, where you need to think about, are you cautious or aggressive, is also what you buy and where. You know, some people like to buy well, it would have done very well, I guess, like a car parking space in Hong Kong, and that's probably a bit higher risk, but the returns are phenomenal. I'm sure Tim can you know, tell us about that one. Other people, of course, will look to try and buy maybe something in an emerging market. Again, you know, the returns can be fantastic, but the risk is also there. Tagging onto that is FX, which I think we'll talk about a bit more later, but this is a big potential gain, but also, you know, a real genuine risk to think about, because a lot of people buy property in a country where they don't live, and where they don't earn money. So you straight away have a Forex risk with different currencies. Now, some people like to try to use that with a multi-currency mortgage. Again, this is where, you know, an aggressive risk profile, you know, you might actually do very well with that, but it could work the other way. Interest rates can change, currencies can go up and down, and you're basically trying to play two off against each other. So I think your risk profile is important, and you need to ask yourself the questions of, what are you looking to achieve? What's your financial situation today? What is potentially going to change in your financial situation or personal circumstances in the next 6 months, year, 2 years, 3 years, 4 years? And also, what are your goals? And I think it's important to start with that, work out where you are on this scale, and then invest accordingly.
If I can just pick up on two quick things there. So I think currency is really important. I remember back in the day, a lot of people buying foreign currency mortgages, which I always thought was a really big mistake, because property is property and FX is FX. So yeah, back in the day in Asia, you might remember, Ian, people buying Aussie properties and taking Japanese yen loans, because it was a fantastic trade as long as you didn't get caught out on the currency risk. So you were getting a 6% yield in Australia and a 1% mortgage, which is great if you're in the same currency, but there's a reason why that's so easy. And the reason is that your underlying assets in one value and the debt is in another. And if the currencies move in the wrong direction from each other, you can be in a real mess. And it happened.
I mean, exactly I saw that firsthand, not through personal experience, but through people that I knew. You know, living in Singapore, the interest rate has been pretty much zero forever. When I first moved out here in 2006, the interest rate was a lot higher in the UK. So people were actually taking a multi-currency mortgage on a UK property in Sing dollars. And as you say, yeah, the interest rate was fantastic. The currency moved the wrong way, and that actually caused a lot of people a lot of financial hardship, actually.
Well, again,
it could have gone well, and they would have made a lot of money or saved a lot of money. But again, that's where it comes down to, what's your risk profile and what are you trying to achieve with the property as well? Yeah.
Good. And the other thing I would say as well is risk also comes down to where you're buying the property. People ask me a lot, should I buy here? Should I buy there? And look, IP Global over the years have had our dalliances with some far-flung markets, and some have worked out very well, but some have been challenging. And owning a property in a market where there's a murky legal system, you're not sure whether you can own the underlying asset or it's a lease or a short-term lease. And it's not worth it. It's really not worth it. You know, I would always buy in places where you can get a concrete understanding of the ownership structure, and you can own it in your name, and you don't need to go and get married to own it or rely on somebody's brother-in-law, because that's not a great way of investing. Anyway, I see a slide has come up that's asking about research, which I presume, Nicola, is for me to talk about, is it?
Yes, thanks, Tim. If we could just briefly discuss some of the important things that you say we need to absolutely research before putting any money down.
Yeah, some of these I'll jump over fairly quickly because I think we've covered them already. But certainly, if you're looking at a property market, you want to understand the underlying economics. Is it a good market? Do we believe the GDP of the country has got legs, that you're going to see decent growth, that you're going to see wage inflation, that you're not going to have huge amounts of unemployment, and that you believe economically that the country you're investing in is a smart one over the medium to long term. And that goes for any investment in any asset class. If you're buying stocks, you don't want to be buying stocks in a country where you think there's huge amount of economic uncertainty, or indeed political uncertainty and overthrows and such like. So again, I think you need to be comfortable that you're in a stable political environment. When I say stable, I mean, you're going to see governments changing, but not whole political systems and overthrows and goodness knows what. So again, keep it simple, keep it to markets you understand with strong systems, politics, economic future growth, and as I said before, legal systems that you believe that there's a strong ownership opportunity with the property, that the property isn't going to be contested by somebody else. I mean, over the years, even places like France, Paris, from time to time, you've got to be very careful when you're buying, even in a market like that, because the ability for a foreigner to go and buy property in France, in Paris, places like that are quite tough, because a lot of the properties are preserved for local ownership. So very important that you understand all of these things before diving in. And again, the markets we're in now are very, very strong, dependable, simple legal systems, where you buy the property in your name, it's owned by you, and there are deeds to that property, and no one can take it from you. Affordability is extremely important. Not your affordability. I'm assuming that before any of you invest in a property, you understand that you can actually afford it. But is it affordable to the local future buyer? Because that affects my point 2 down, which is liquidity. Your future buyers are not investors. Your future buyers are homeowners. Don't buy something you can only sell to an investor. And that's the reason over the years why I've generally avoided buying hotel rooms, kind of buy-to-let condos where you're shared ownership in a hotel. I don't like those investments, and I don't like them not because the yields aren't good or because they're not an attractive kind of investment in and of themselves, but who's buying them in the future? When I buy an apartment or a house, I buy it to rent it out, but I also buy it with the notion that one day I want to sell it. Who am I going to sell it to? If I can only sell it to investors, then I'm limiting my future liquidity, which is the point I got to there. So make sure you're buying something where there are people that will want to live in it and own it in the future themselves, where it's near to schools, near to tube stations, near to bus stops, near to roads, near to places where future buyers, local buyers, will also want to live. Which is why we love, and I've loved over the years, London, and we've loved Birmingham, and we love Sheffield, and we love Lisbon, and the local population want to buy those apartments, but you need to make sure they can afford to. So you're buying properties that are affordable to the local buyer. I think we've talked enough about currency and financing and yields. I think we'll talk about a bit more later, but do your research on your yields. Don't believe everything you read. It frustrates the heck out of me. We have a lot of head scratching in our office about some of the and I'm going to be careful here, some of the nonsense that some of our competitors come out with when they misrepresent the yield of a property to their investors. That it's scandalous that you believe you're going to get a rental that's not going to happen. So understand what the rent is, and you're going to pay fees on the rent. You're going to pay management fees. You're going to have to pay for insurances and so forth. So understand what the real net yield is to you, and also understand what tax you're paying on your profit and what your costs are when you're buying into it. And again, we produce cash flow analysis, and we show you, if you're buying a £232,000 property, this is what it's going to cost you with stamp duty and your deposit, and make sure you're doing this with your eyes wide open. So I had to rush through a lot of things there.
No worries. Thank you so much, Tim. All right, now we have a couple of questions that Tim asks before he invests. I think we'll only go through 2 of these, Tim, because we're a bit short of time, and then we can open it up to our guests. By the way, everybody, if you have any questions, please submit them in the box below. We will get to hopefully 5 or 6 by the end of the webinar. All right, over to you, Tim.
Yeah, I just alluded to this before. So what will the net rent be? So make sure you get, your biggest cost of owning a mortgage, of owning a property by a mile, is your monthly mortgage cost. So if you're leveraging it, you're paying X amount out every month for ownership of property. And the last thing you want is to be unknowingly in a situation where you have a negative carry every month. Now, some people do have a negative. I mean, some of my properties, the rent doesn't cover the mortgage. And I do that in the knowledge that I don't mind that. I can afford it. I'm very optimistic about the future growth of that property. I'll take that gamble. I'll take that risk because I've got my eyes wide open about what I need to provide each month. And many of our investors are in the same situation. But make sure don't be caught out by thinking something's going to be in a positive net position each month, and it isn't. So understand what the net rent will be. For instance, you buy a property and the forecasted rental income is 4.3%, which is not unusual. Okay, is that the net yield or the gross yield? Because from that 4.3%, if that's £1,800, for instance, you're going to have maybe up to 15% in monthly management fees and letting fees. You're going to have to, pay ground rent income on an apartment, for instance. So does that £1,800 become £1,500? Just be clear about it. It doesn't mean it's a bad investment. It might very well be a very good investment, but understand what the net rental yield really is. And we're not the only ones. There are companies out there that will help you understand that. But, double check. If a company's saying a 2-bed flat in the Jewellery Quarter in Birmingham will get you £1,150 a month in rent, go do some research on Rightmove and make sure you're being told the truth. It's important you do your own research as well. So that's number one. Yields are important. They're very important, but make sure you're not misled about what the yields are. I would argue you don't always, if you can afford it, the yields don't necessarily need to cover your mortgage if you are investing for the long-term capital appreciation. But if you can't afford to support the mortgage without the rental yield, make sure you do your homework. Who is the developer? Very, very important. We've had, 2 or 3 over the years where we've had challenges with our developers. I won't lie. How do you guard against that? You do as much research as possible. In the main, you can either go and see it, or you can get a Google Maps and have a look at it. You can go and research the developer, just get comfortable. We do a huge amount of due diligence on our developers. We look at their finance situation, their leverage in terms of what debt they've got. We look at their track record, make sure we're comfortable with what they're doing, that they're building the scheme out. And 99 times out of 100, there's always a challenge where something may be delayed. We've had a couple, as I say, but make sure you're comfortable who's building the asset out. Personally, I prefer 18-month, 2-year build, 1-year build to a 3-year build, because a long time out. But again, these are the things I ask myself. We do a lot of business with 1 or 2 developers now that we've done 5, 10, 15 schemes with, that we have a lot of confidence in. So really important questions. Okay, we've jumped on to the final one. What's your exit strategy? Again, extremely important. What's your time horizon? Are you buying for 3 years, 5 years, 10 years? 3 years, to me, I think that's a big gamble. Buying real estate for 3 years, you're really banking on the market going in the right direction. Anything less than 5 years is a bigger gamble. I think real estate is a 5-year, 10-year investment asset. What's your exit strategy? Make sure what you're buying has got the maximum amount of future liquidity possible, i.e. other investors might buy it, but also local homeowners will buy it. The tenants that are renting your property probably have an aspiration one day to be buying a property like that. And that's the essence of what you should be doing, buying something that you're not going to hold forever. Some of you might want to give it to your kids. They might want to go to university there, but your circumstances may well change. And as Ian will tell you, everything you should be investing in, you should be assuming one day you want to cash out, take your profit and go and lie on a beach or something.
All right,
Yeah.
thank you so much, Tim. You have actually touched on quite a few of these points in the final slide, cautionary advice. So Ian, what about you? What can you leave with our investors and our guests?
Yeah, well, I think, as you said, Nicola, Tim's covered nearly all of these. We did talk about a lot of this as well earlier on, particularly with currencies as well. Again, it goes back to what I said about your risk profile. If you're super aggressive, you want to try to play the currencies, you can do. It can go very well, it can go very badly. Property may not be the way to do that. Perhaps the FX markets is a better way for you to achieve that. So I think, again, it comes back to, why are you buying the property and what are you trying to achieve? My background's financial planning, and, that's really the questions we ask right from the very beginning when we sit down with our clients is, where are you today and where do you want to be tomorrow? Because, the currencies, I think, actually is it's a very forgotten thing actually in property. So most of my work and most of my wealth management, happens with stocks and shares, a bit with bonds, and some of it does come down to FX cash management, not FX trading, but FX cash management. Where are you going to retire? Where are your children going to go to university? Where are you going to move to in the next couple of years? Now, when you buy a property, what I've seen is most people completely forget about the currency. They just forget about it. So it really is something to think about. Perhaps the country and currency, again, is somewhere you're going to end up living in the future. You take a different approach. So really do pay attention to your earning currency today and also the currency of the underlying property. Linked to that is the risk with loans, etc. And, the first point there actually is another important one. And it's one of the reasons why, I liked working with IP Global is, can you actually find financing for the property that you want to buy? You think it's going to be easy. It should be. You'd think banks are, definitely should be very keen to lend you money and make money on it. But it's surprisingly difficult. I'm British and I maintain a UK bank account. I have UK investments. And my property in the UK was very, very hard to get a refinancing on, even though it's rented out, even though the value's gone up. So, make sure it's in a location that's obviously good and that you can get financing. And of course, IP Global can help you with that as well. Local affordability, Tim spoke about a lot just now, and inflated yields as well. These two go hand in hand. Don't just look at the headlines. Do your research, make sure that, what's the actual net effect? And, inflated yields, again, I can relate, I guess, to my world of stocks and bonds. And a great example, of course, is Evergrande in China. You all know the problems that happened in September. And, we look at Asian high yield strategies, and some of them are very high yield. You can get 9, 10, 11%. But of course, with that comes much higher risk. The very low yields, Apple famously did I think it was a 40-year bond at less than 2%. That's less than inflation. It's crazy if you ask me, but again, it's about that, safe and secure versus high and risky. And I think really you want to find something in the middle. You need the yield, you need to keep up with inflation and take advantage of, what I would say is low interest rates today, it means cheap borrowing. And if you can get a yield that's above that, someone else is paying your mortgage for you. You're making that money and you're staying up to date with inflation. So actually, I think the yields, again, is something that's really quite forgotten when people are doing their research, because don't chase the highest return, but also don't go for something with very, very, very low yield. Find something in the middle, and again, find something that fits your profile.
All right, thank you so much for that, Ian. Tim, do you have any final points before we get to questions? I think you're on mute.
Apologies. No, I don't think so. I think there's some, I had a quick look at the questions while Ian was speaking there, and there's some really good questions. So no, I don't think so. I think we've more than covered everything. So let's get through the questions and see if there's anything we've missed we can answer in that forum.
Fantastic. Yes, we have quite a few of them. I think let's start with Adam's question. How do you think the pandemic will affect the desirability of city living? I think that's for you, Tim.
I think that's a brilliant question. I really do, because we're all sort of still scratching our heads a bit. If you'd asked me 6 months ago, I think there was much more concern about people moving into the cities. If you look at London now, I get to London a fair bit. I get to Birmingham, going there in a few hours. People are moving back to their offices now. I think people are starting to realise that businesses don't function quite as well as they thought they did just by doing it like this. And I am still a big advocate of face-to-face, of spending time collaborating and working with colleagues. So I think, yes, particularly tech industries, people will settle to working at home a lot more. People have found different ways of working, but the advent of people not going to offices anymore has been massively overplayed. I think companies will use flexible offices a lot more. The need for office space will reduce. And I think that the part a city plays in people's lives over the next 10, 20 years will change. I think it will be a place people live. There'll be places that people go in and out to their work, but it won't be I don't think you'll see cities kind of die at the weekend. I think people will be living there. And you already see it now that with a lot of office to residential conversions, that old office buildings that were previously obviously used for work and now been used for living. So I think you'll see more of that. I think you'll see less office space in some cities, but I still think that means you'll still see people living in those cities. Definitely, I think it's driven developers, rightly so, to think about outdoor space, balconies, communal living, gardens, really important, because if people are working from home, they don't want to be in a 400 square foot apartment, as I lived in Hong Kong, as you live in, Nicola, and many people do, without any other communal support. So I think you'll see developers being much more creative and thoughtful about creating an environment people can have outside of just their apartment. And if they don't, people won't rent and buy those apartments. So we're thinking about it too.
Thank you.
Can I just add in there, because my own experience, I live in Singapore, which is, I think the apartments are slightly bigger than Hong Kong, but they're still not very big. I actually, so two things happened recently. I moved house, number one, well, not a house, apartment. And the trend that, we're talking about, where people are moving out of the city, if you like, and, into the quiet areas. I mean, Singapore is smaller than London, so it's a very, very small country. But everywhere on the outskirts, can't find anywhere, or the price goes up, or the rent goes up, or it goes before you can even view it. But what's interesting is it's not literally in the middle of nowhere, where obviously you can get the biggest places for the cheapest price. All it means is the absolute city centre, the business districts, the demand has gone down. But the outskirts of the city, the demand has gone up massively. And I think the key to what Tim was saying, and I guess the question was asking, is it's not necessarily, if you use the UK as an example, living in the countryside in a nice farmhouse. That sounds great. And for some people it is. I would certainly like to do that, but maybe for a couple of weeks a year, maybe for a month of the year. People still want amenities. They're used to a certain way of living and certain basic, things on their doorstep. So I don't think the city living story is just going to die overnight, as Tim said. I can't see that at all. And I can, visually actually witness that in Singapore and also in the UK. I was just back there a month ago, and I'm from London originally, and we were planning a trip up to the Peak District. So I said, who wants to share a ride up there? There's no point all of us driving. And then someone mentioned in the WhatsApp group, no one lives in London anymore, Ian. But it wasn't that they didn't live in London, they just didn't live in central London. A lot of people live on the outskirts and the surrounding counties and commute. So I think the story for prime sort of central business district, that may struggle, and maybe it needs, developers to adapt. But I think when you're on the outskirts of cities or in regional cities within the country, that is where there's going to be massive appeal, I think.
Well, I think that's an important point, because, and I know we've got other questions, but if I take Birmingham as an example, we've got a project in the Jewellery Quarter, which is a fantastic warehouse conversion. And that shows the change of how life has changed in the last 100 years from what used to be a very red brick industrial warehouse jewellery area where they made all the, where people made watches and necklaces, and now people are living there. Most of those buildings don't even have parking because the people that rent those apartments and live in those apartments don't drive. The government, the local authority doesn't want to give parking spaces because they don't want people to drive, but there's a tram. They can get into work, but it isn't just about work. They can work from home, but when they want to go to the theatre, they can walk into the city centre or to the movies or for dinner. People don't just live in cities because they work there. A lot of people want the convenience of life that happens there. And take the Birmingham example, they can then get on the new metro line, and they can get on, which links up to the HS2, and they can be in Manchester or they can be in London, either one within an hour. So they can see relatives, or they can go to the theatre in London, or they can go to Heathrow Airport. And you can be in Heathrow Airport in an hour and 20 minutes from central Birmingham if you go HS2 and then link up. I mean, that's probably even less, actually. I mean, that's crazy. You couldn't do it in 2.5 hours in a car. So city living will be for different reasons. And that's why people are still buying and living in those places, not necessarily because you're doing a 9 to 5 in an office building down the way. You might only be going in Wednesday afternoons and all day Monday.
All right, thank you so much, Tim and Ian. Let's hop on to the next question. I think we only have time for 2 more, if that's all right. All right, do you think in a diversified portfolio, it should include residential and commercial properties or purely residential?
I'll take that one. I think if you can afford both of them, then both of them. I think the commercial sector is more challenging at the minute because for the reasons I've just stated before, in all cities around the world, there's a nervousness about commercial. The other problem with commercial, really, the barrier to entry is for your would-be individual investor with 20,000, 50,000, 100,000, or even $1 million. It's very difficult dollars. It's very difficult to get into commercial real estate because you're talking about big numbers, unless you're buying retail, and then you end up buying a REIT. I hate property funds. Most of them have not performed well over the years. You're owning a tiny bit of a huge asset which you don't get to have any involvement in. So I think if you can, it should, because they have a part to play. But the commercial sector right now is, I think, a more risky place to put your money because we don't really know where the commercial world's going in terms of office space. How many desks do Google need compared to what they needed 2 years ago before COVID? Do they still need that many desks around the world? Do they need half as many? Are they going to have their people work 50% at home? Until these things are settled, I think the notion of owning commercial real estate is one that you should think twice about.
Yeah, I agree, actually. I mean, one of the few areas on property that I can, my license does cover in terms of advice are REITs. And, in the past, we've used them a lot. You've seen some great capital growth, some fantastic yields, and they've been great. They've been a very important part of investment portfolios. Today, well, not just today, but certainly in the last year and a half, I've really been advising people to stay away from them. Again, that's my personal view, but like Tim said, I think no one's really expanding office space, let's be honest. If anything, people are contracting. I know we are as a business, again, not because we're downgrading or we're trying to reduce the size of our company, not at all. It's just, again, to accommodate flexible working, hot desking, better use of space. And, the example Tim made of Google, that goes through all of the tech companies. And not just tech. I mean, even like a good example, Visa. I guess it is kind of tech, but it's a financial company. They've got a Google or Facebook style office, with an arcade, a table tennis table, all these sorts of things. And, frankly, they're just going to reduce their office space. And I think this filters through not just the offices, but also other areas of commercial, retail. E-commerce has been taking over before the pandemic, before COVID-19. And COVID-19 just accelerated probably what was going to take 5, 6, 7 years into a few months. So I really think that even retail, you've got to be really careful with it.
I'll tell you what, though, Ian, what it does do is being able to convert those properties, commercial and maybe even retail, into residential is great because all of those offices were put there because they've got great infrastructure.
Yeah.
So most offices are in good places because people have got to drive there to work or get the tube or get the MTR or get the train, whatever. So by default, those offices are in great locations that are very commutable, are good for access to train stations and airports. So to put residential apartments there makes a lot of sense. And, you know, more and more we'll be looking, and I'll be looking to invest in those kind of buildings because they're great places for people to rent and to buy apartments.
Fantastic. Thank you so much, Ian and Tim. All right, final questions. Do you have any particular questions? I know both you, Ian, and Tim can see them that you would like to answer, or I will select one.
I can answer one really quickly. I may be able to do a couple really quickly. What's the time frame for buying a property and then leveraging it to buy the next one? I don't think there's any time frame. If you get really lucky and the property goes up by 20, 30, 40% in 3 years, take your chance to do it again whenever you can. So I think it really depends on the asset value. But, you know, I didn't do a lot of that in the early years of my investing because the asset value didn't go up enough. I didn't have the money. But then suddenly the market jumps and then you take your opportunity. So there's no perfect scenario. Quick couple of others. Turkey. Somebody's asking about should they invest in Turkey. Definitely currency, I think, is a nice play at the moment. Our experience of Turkey is difficult with mortgages, unless you're Turkish national. So that may be something you need to consider when you're buying in Turkey. And also stick to Istanbul, stick to the big cities, make sure you can get your rentals. Any other quick one here? Oh yeah, somebody says how many countries should you, sorry, I'll do one more. How many countries should you invest in? Depends what appetite you've got, and it depends how many hours in the day you've got, Martin. You know, I think at my peak I had properties in 10, 12 countries, and that's a lot of hours of the day, even if you've got help. So generally I think you should stick to 1 or 2 or 3 and make it countries you understand and have got some experience in, or you know, don't feel there's a great risk. I think you can spread yourself a bit thin, and I've definitely made that mistake in the past.
Yeah.
Thank you, Tim.
I'll stop there.
If we've got time, very quickly. So someone has also asked about decision to remortgage a paid off property to make an equity down payment elsewhere. I know we've talked a lot about this already, and hopefully our opinions are quite obvious. But I'd just like to stress once more. Oh, hello.
Sorry, my phone started speaking. Sorry.
I just said Sunderland. I'm not sure if I'll be investing there tomorrow, but maybe Newcastle. But anyway, yeah, I mean, look, is it a sound decision to remortgage a paid off property to buy somewhere else? Again, it comes down to your risk profile, but I would say absolutely yes, because we're in this, you know, when I moved to Singapore, which is a long time ago, interest rates were 5-6%. I mean, I don't know what a mortgage cost back then, but obviously it'd be more than that. Today, we are at, let's call it 0. I mean, I know mortgages always come in more expensive because banks like to make money, but we've got probably the cheapest money that we can possibly get, certainly in my lifetime. And I think this will last for another 5, 6, 10, 11, 12 years. Everyone's talking about interest rates going up, and they will at some point, but they're not going to be 5 or 6% anytime soon. So for me, the ability to take money out, remortgage, potentially you can reduce your payments anyway, but to actually get equity out, and to reinvest it. The question, you know, whether you're talking about property or, like I said, for me, day to day is about cash versus stock investing. Can you borrow money? So let's say your mortgage is 3, 4, 5%. Can you borrow the money and can you make more? So if you can borrow at 3% and you can get a 5% yield, you're making 2%. Someone else is paying your mortgage, you're making money. It really is a unique opportunity if you can find the right investments. And I'd say, again, risk assess, and everyone's in a different situation, but generally, absolutely take advantage of low interest rates and take advantage of property yields and potential growth.
Thank you very much, Ian. All right, that's all the time we have. Thank you so much to our hosts for a very informative presentation, and thank you to all of our guests for joining us. If you would like the presentation, if you weren't able to watch the whole thing, we will be sending that afterwards. And if you also have any more questions, please do submit them directly to inquiry@ipglobalLTD.com, and we will get back to you. A wealth manager in your region will get back to you shortly. All right, thank you, everybody.
Thank you. Bye-bye.
All right, bye.